Asian guy here, and I need to ask you a question that's going to make you uncomfortable. Do you have a 401k, a pension, money sitting in a target date fund or an index fund that you contribute to every paycheck, trusting that some algorithm somewhere is diversifying your retirement savings? If you answered yes to any of those, I have bad news. Starting January 9th, 2026, that's 5 days from now, your money is going to be weaponized against you. Not by hackers, not by some offshore scam, but by the very financial institutions you trusted to manage your future. Your retirement account is about to become the exit liquidity for Wall Street's biggest players. And the worst part, it's completely legal. Let me show you how they're going to do it. 3 days ago, TD Securities, one of the largest commodity desks in North America, published something that should terrify every person saving for retirement. Hidden inside a routine market commentary, they revealed that roughly $5 billion worth of silver futures contracts are about to be sold over a 5-day period. Not because silver is overvalued, not because there's a glut, but because of something called index rebalancing. Now I know what you're thinking. I don't trade commodities. I don't own silver futures. Why should I care? Here's why you should care. That $5 billion in forced selling, a huge chunk of it is coming from your retirement account, from passive investment funds that manage trillions of dollars on behalf of teachers, nurses, factory workers, retirees, people who have no idea their money is being used as ammunition in a market manipulation scheme. And before you click away thinking this doesn't affect you, ask yourself, do you own any fund that tracks the S&P GSCI, the Bloomberg Commodity Index, any diversified commodity exposure, ETF that your financial advisor recommended? Any target date, 2040 or 2050 fund that automatically rebalances? If yes, then congratulations. You're about to be forced to sell silver at exactly the wrong time. And you won't even know it happened until it's too late. But I'm getting ahead of myself. Let me back up and explain how this scam works. Because once you see the mechanics, once you understand who profits and who loses, you're going to be furious. The story starts with something that sounds boring and technical, index methodology. These massive commodity indexes, the ones that pension funds and institutional investors use as benchmarks, don't just sit static. They rebalance periodically to maintain specific weightings across different commodities. Oil gets a certain percentage, gold gets another, copper, natural gas, silver, all weighted according to formulas designed by PhD economists in glass towers. In 24, silver was a tiny part of these indexes, maybe 3% to 5% of total commodity exposure. Nobody cared. Silver was boring. It traded sideways for years. Fund managers ignored it. Retail investors yawned at it. It was the forgotten metal. Then 2025 happened. Silver didn't just go up, it exploded. From around $25 per ounce in January 25 to over $80 by year end. A 150% gain, the best performing major commodity of the year. It outpaced gold by more than double. It crushed oil, copper, wheat, everything. Now here's where the trap springs. When silver goes up 150% in a year, it's waiting inside these commodity indexes balloons. It's no longer 3% of the index. It's now 8%, maybe 10%, depending on how the math shakes out. The index formulas say, silver is overweight. We need to reduce exposure back to target allocation. So what happens? The algorithms send orders to sell silver futures until the weighting comes back down. Not tomorrow. Not when it's convenient. Not when the market conditions are favorable. Now, mechanically, without regard to fundamentals, sentiment, or common sense. This is the dark side of passive investing that nobody talks about. These funds are marketed as safe, diversified, low cost. But the dirty secret is that they're slaves to formulas. And when the formula says sell, they sell, even if selling at that exact moment is idiotic, even if it crashes the price, even if it transfers wealth from you to the vultures circling below. And who are those vultures? Glad you asked. Because this is where it gets truly criminal. See, index rebalancing is not a secret. The Bloomberg Commodity Index publishes its methodology. The rebalancing schedule is public information. Any sophisticated trading desk, and by sophisticated, I mean the desks at JP Morgan, Goldman Sachs, Morgan Stanley, all the usual suspects, knows exactly when this forced selling is going to happen. They can calculate almost to the contract how much silver will be dumped. They know the timeline, they know the volume, they know the passive funds have no choice but to execute. So what do you think these banks do with that information? They position themselves on the other side of the trade. They go short ahead of time. They push the price down preemptively. And then, when your pension fund shows up on January 9th with orders to sell $5 billion worth of silver futures because the computer says they have to, those same banks are sitting there ready to buy it at a discount, at prices they helped engineer downward. It's like playing poker against someone who's forced by rule to fold their hand at a specific time. You don't have to outplay them, you just have to wait. And when they fold, you scoop the pot. Your retirement savings are the pot. Wall Street is scooping. But wait, it gets worse. Because the banks don't just profit from the rebalancing trade itself, they profit 3 more times on the same move. Let me walk you through the full playbook so you can see just how thoroughly they're robbing you. Step 1. Front-run the announcement. Before TD Securities even published their research note warning about the $5 billion in forced selling, you can bet their own trading desk was already positioned. They shorted silver 2 weeks ago when it was trading at $82. Now that the warning is public, retail traders panic. The price drops to $75. TD's desk books a quick $7 per ounce profit on millions of ounces. First score. Step 2. Engineer the crash during the rebalancing window. When your pension fund starts selling on January 9th, those banks don't buy right away. They let the price fall, they add to their short positions, they trigger stop losses from smaller funds. The price drops from $75 to $68. Now they cover their shorts for an additional $7 per ounce. Second score. Step 3. Buy at the bottom. After the forced selling exhausts itself, after every passive fund has executed its mandatory rebalancing orders and there's no one left to sell, the banks reverse course. They go long, they buy aggressively, the price rebounds to $76. They flip their position for an $8 gain. Third score. Step 4. Sell the recovery to the next group of idiots. By late January, momentum traders see silver bouncing. They pile in. The banks who bought at $68 sell to them at $80. Fourth score. 4 separate profit opportunities, all from the same rebalancing event, all extracted from the forced selling of retirement accounts that had no choice in the matter. And here's the part that should make your blood boil. The retirement savers, the teachers, the nurses, the engineers contributing to their 401ks, they experience the opposite. They're forced to sell silver after it's already dropped. They lock in losses. They miss the rebound. And then because the index is now rebalanced back to a lower silver weighting, when silver goes to $100 or $120 later this year, their funds won't own as much of it. They'll underperform. This is wealth extraction masquerading as portfolio management, and it's perfectly legal because it's hidden inside the machinery of passive index investing. Now, I want to zoom out for a second and talk about why this matters beyond just one commodity and one rebalancing event. Because what's happening to silver right now is a microcosm of a much larger problem. And if you don't understand this problem, you're going to spend the next 30 years getting systematically looted. The financial industry has spent the last 2 decades convincing average people that passive investing is the safest, smartest way to build wealth. Don't try to pick stocks, they said. Don't try to time the market. Just put your money in a low-cost index fund and let it compound over time. And on the surface, that sounds reasonable. Index funds have lower fees than actively managed funds. They're tax efficient. They track the market instead of trying to beat it. All true. But what they don't tell you is that passive funds are passive only in one direction. When the market goes up, yes, you ride along. But when the market corrects, or when an index rebalances, or when there's forced selling for technical reasons, you ride that down too. You have no say. No protection, no ability to step aside and wait for better prices. Active funds, for all their faults, at least have the option to hold cash, to hedge, to not participate in a forced liquidation. But passive funds, they're on rails. The algorithm is in control. And when the algorithm says sell, you sell. Even if it's the worst possible moment, this is what's about to happen to silver. Passive commodity funds are going to dump billions of dollars worth of futures contracts, not because silver is weak, but because a formula says they're overweight. Meanwhile, the active players, the hedge funds, the proprietary trading desks, the billionaire family offices, they're going to buy the dip. They're going to accumulate at discounted prices. And when the selling stops and the price recovers, they'll own what your retirement fund just sold. The wealth transfer is silent, invisible, legal, but it's happening. So let me give you the counter-narrative that the financial industry doesn't want you to hear. The story they're terrified you'll figure out. While your pension fund is being forced to sell silver because it's overweight in the index, the physical silver market is in the tightest supply squeeze in decades. I'm talking about real, actual metal. The stuff you can hold in your hand, the bars sitting in vaults, the coins being minted for industrial use. Just last week, a portfolio manager at Invesco revealed that some buyers were having to transport silver by plane instead of waiting for cargo ships. Think about how insane that is. Air freight costs 10 times more than ocean shipping. The only reason you'd ever do that is if you're desperate, if you absolutely cannot wait. If the alternative is shutting down your production line because you're out of silver, who's airlifting silver? Not speculators, not retail investors, industrial users, companies that build solar panels, electric vehicles, 5G infrastructure, companies that need silver to function, and they're willing to pay absurd premiums, $15, $20 above spot price, and absurd shipping costs just to get the metal immediately. So on one hand, you have industrial demand so intense that companies are chartering planes. On the other hand, you have Wall Street telling your retirement fund to sell because silver is overvalued. Does that sound right to you? Does that sound like a fair market? Or does it sound like the people managing your money are either incompetent or complicit? I'll let you decide. But I'll also give you some context that might help you reach the right conclusion. The COMEX, which is the exchange where these silver futures trade, currently has about 28.7 million ounces of silver in its registered category. That's the metal available for delivery against futures contracts. Meanwhile, the open interest, the total number of contracts claiming ownership of silver, represents about 900 million ounces. Do the math. That's a leverage ratio of 31 to 1. For every ounce of real silver in the vault, there are 31 paper claims on it. Now, when your pension fund sells its silver futures, it's adding to that paper supply. It's making the leverage ratio even worse. It's helping to suppress the paper price, even though the physical shortage is getting more acute by the day. And guess who benefits when the paper price gets suppressed while physical demand stays high? The same industrial buyers who are airlifting metal. They get to lock in futures contracts at artificially low prices, prices that were driven down by the forced selling from your retirement account. You're subsidizing Apple's silver purchases. You're subsidizing Tesla's silver supply chain. You're giving Elon Musk a discount on the metal he needs to build his cars and solar panels because your index fund had to rebalance. This is the scam. This is how the system works. The little guy is forced to sell, the big players buy cheap, and the financial media calls it efficient market functioning. But let me give you a glimmer of hope here, because if you understand what's happening, you can position yourself on the right side of this trade. You can be the beneficiary instead of the victim. Remember, the forced selling is temporary. The rebalancing happens over 5 trading days starting January 9th. By January 15th, it's over. The passive funds will have executed their orders. The selling pressure will dissipate. And then the market will reassess based on fundamentals instead of mechanical selling. What are those fundamentals? Let me list them for you. Number 1, silver just had its best year since 1979. It's up 150% in 2025. That kind of momentum doesn't reverse because of a 5-day technical sell-off. It pauses, it consolidates, then it continues. Number 2, industrial demand is at record highs and accelerating. Solar panels, electric vehicles, electronics, 5G, all growing, all require silver, all facing supply constraints. Number 3, mine production is stagnant. You can't just turn on a silver mine like a faucet. It takes 10 to 15 years to develop a new project. The deficits we're seeing now will persist for years. Number 4, the U.S. government just designated silver as a critical mineral essential to national security. The Pentagon is preparing to stockpile it. That's not speculation, that's policy. And when the government enters the market as a buyer, they don't negotiate on price. They pay whatever it takes. Number 5, China locked down its silver exports on January 1st. The largest refiner of silver in the world just closed the door to Western buyers. That removes hundreds of millions of ounces from the accessible supply pool. So ask yourself, in a market with those 5 dynamics, does it make sense to sell silver because an index formula says you're overweight? Or does it make sense to hold on, ignore the noise, and let your retirement account capture the gains that are coming over the next 12 to 24 months? Unfortunately, if your money is in a passive fund, you don't get to make that choice. The algorithm makes it for you. And the algorithm is stupid. It doesn't understand geopolitics. It doesn't understand supply deficits. It doesn't understand that sometimes the right move is to do nothing. But you're not helpless here. You have options. And I'm going to lay them out for you now. Option 1, if you have control over your retirement account. If it's an IRA or a self-directed 401k, consider moving a portion out of passive commodity funds and into direct silver exposure. Physical silver ETFs like PSLV, mining stocks, anything that isn't forced to rebalance when the index says so. Option 2, if you don't have direct control because your employer manages the 401k, at least be aware of what's happening. When the rebalancing hits next week, when silver drops $10,000 or $15 in a few days, don't panic. Understand that it's mechanical selling, temporary, not reflective of fundamentals. Option 3, if you have capital outside your retirement account, savings, investment accounts, dry powder, use the rebalancing window as a buying opportunity. Wall Street is creating a gift for you. They're suppressing the price so you can accumulate at a discount. Take advantage of it. And option 4, the most important one, start questioning the whole premise of passive investing. Start asking why you're giving control of your financial future to an algorithm that can be gamed by the very institutions you're supposed to be competing against. I'm not saying you should day trade. I'm not saying you should try to time every market move. But I am saying that blind faith in passive index funds is a recipe for getting fleeced. Because the indexes are managed by human beings. And those human beings work for institutions that profit when you're forced to sell and they're positioned to buy. The game is rigged, But it's only rigged if you play by their rules. If you understand the rules, if you see the traps before they spring, you can avoid them. You can even profit from them. Here's what I expect to happen over the next 30 days, and I'm putting this on the record so you can come back and check my accuracy. January 9th through January 15th, forced index selling hits. Silver drops from current levels around $73 down to $65, maybe $62 if the selling is particularly aggressive. Mainstream financial media runs headlines like silver bubble bursts and commodity correction underway. Retail investors panic. Mining stocks get crushed, dropping 30% to 40% in sympathy. January 16th through January 25th. Selling exhausts. Physical buyers step in aggressively. The price bounces hard. Silver recovers to $75s, then $78. Mining stocks rebound 50% to 60% from their lows. Media goes silent. No headlines about the recovery. Late January through February, Pentagon announces initial procurement contracts for silver stockpiling. Industrial users realize the China export restrictions are permanent, not temporary. Panic buying begins. Silver breaks above $85. Then $90. Mining stocks go parabolic. March 2026. We look back at the January rebalancing as the last great buying opportunity before silver repriced to triple digits. The passive funds that sold in January are stuck with lower weightings and missed the run. The active buyers who accumulated during the forced selling are up 40% to 50%. That's the playbook. That's how this unfolds. And the tragedy is that millions of people saving for retirement will be on the wrong side of it because they trusted an algorithm. Don't be one of them. Don't let Wall Street use your retirement as exit liquidity. Don't participate in a forced sale that benefits hedge funds and hurts savers. Understand that silver isn't being sold next week because it's weak. It's being sold because a formula says so, and formulas don't care about your future. They don't care about supply shortages or Pentagon stockpiling or Chinese export bans. They just care about maintaining target weightings. But you should care about those things, because those are the fundamentals. Those are the forces that determine where the price goes over the next year, not the next week. And if you let a 5-day technical sell-off scare you out of a position that has years of runway left, you're going to regret it. So here's my final challenge to you. If you own silver, directly or indirectly, make a decision right now. Are you going to let the rebalancing shake you out? Are you going to trust the algorithm that's being gamed by Wall Street? Or are you going to recognize this for what it is? A temporary distortion created by forced selling from passive funds that have no choice, and hold through it. Because on the other side of this rebalancing, silver is going higher. The fundamentals haven't changed. The shortage is real. The industrial demand is growing. The government is entering the market. China has locked supply. These are facts, not opinions. And facts eventually overwhelm formulas. Your retirement is too important to be a pawn in someone else's trading strategy. Take control, understand what's happening, and position yourself to benefit instead of being victimized. I'm Asian Guy. If this opened your eyes to how passive investing can be weaponized against you, hit that subscribe button. Because over the next 30 days, we're going to document every step of this rebalancing event. We're going to track the price. We're going to watch the pension funds sell and the hedge funds buy. And we're going to prove that understanding the game is more valuable than trusting the institutions running it. Your retirement is under attack starting January 9th. Now you know why. Now you know who profits. And now you know what to do about it. Don't let them steal your future. The forced selling is coming. But so is the recovery. Make sure you're positioned for the right side of that trade.